In this video, we're actually going to do the control cost calculation on the whiteboard, and we're going to talk about if you could borrow at 5 and you could earn a greater rate of return than 5, that would be a net positive. You're essentially using leverage and your cash is still growing in your policy. It's going to do that regardless. Now your opportunity is creating a net value. And so those two things together obviously are an amazing thing. And so when I make the statement, if I had the ability to borrow at 5 to earn 7, I would turn that down. And you might be thinking, why? Well, the reason is, yes, I would make a rate of return, but the opportunity costs of saying yes to a mediocre deal would take me potentially out from going all in or saying yes to an even greater deal. So I want you to take this all with a grain of salt, because this is not a pass to just say, hey, I need to borrow money to do certain things. We have to factor in things like risk. You have to factor in things like opportunity cost. You have to factor in other things as in unknowns. And just because mathematically it might make sense, it might not make sense to you. And so it's really important that you understand that, and you really understand the opportunity cost of the opportunity cost of not having unlimited funds, and making sure that you use your money in a powerful way. And so for me personally, I don't take policy loans unless I have a firm belief that I can invest in a person, myself, a business that creates massive rates of return. When I understand that and understand the risk associated with that, then it becomes an even no-brainer. I don't even need to do a math equation like this, but you'll see how understanding the math behind control costs and rates of return will make you a better investor, and will answer the question, should you take a policy loan or not? So one of the things that I want to do is just break down this equation. So when we're talking about should you use your policy, first of all, we have to ask the question, what is the investment? And so for this example, I'm just going to use 12%. Hopefully this is obvious at this point. This is not investment advice. I'm not Dave Ramsey and saying that you can earn 12% in mutual funds. I'm just saying you can, hypothetically, you're saying you can earn 12% in this investment. And let's just say you use your policy. Now, there's additional videos in this section where we're talking about third-party lending. Third-party lending is really strategic because you might use a bank and use their money instead of the insurance companies, because it gives you better terms or cheaper money. And so this could even be better, but I'm just giving you the basic understanding of how to compare this, and just generally how to compare the rates of return you would get if you use your policy. So what you do is you look at the investment, you look at the control cost. Remember, control cost is the cost of controlling money. In this case, we'll say 5%. Okay, so this equals 7. This is a 7%. And then you divide it by 5%. And when you do that, you get a number that's 1.4. Okay, 1.4. And so then you take that number, 1.4, you multiply it by 100, and equals 140%. And so again, you could do this with anything. You could do that. You made a 15% rate of return and other things, and you can see how the math works out. Again, the thing to keep in mind is, what is the risk associated with the investment? What is the likelihood of payout? What are the downside? Can we be more efficient with the control cost? So if I can get the control cost in a better terms, and remember, cheaper money might not be better, because life insurance gives you an unstructured loan. So there's benefits in not having to pay interest or having to pay any loan in a period of time. And so that can be valuable as well. And so at the end of the day, we have to factor all this in, but this is a way for you to, on the back of the napkin, figure out for your own self how to analyze a deal, and how, when we're saying 140%, how you actually understand how the math works and how it's not just magical numbers that we're making up. So hopefully this makes sense. Again, everything that we do is helping us be better thinkers as it relates to using life insurance, using our and asset. And I find that this just helps me as it relates to making decisions and understanding really critically as it relates to when I should use my policy and how I should use my policy. Hey, if you want to learn more about the and asset, check out all the resources, including the 61-page handbook, in the vault below.